Hello Mountaineers, it's Jordan from Mountway Finance here. Now a lot of the times when I'm making these videos I'm responding to what people are asking me about, and it sometimes doesn't strike you that maybe I'm brushing over some topics that are really fundamental. They seem fundamental, but it's really important to get to know these fundamental things to build your understanding of how to conduct your finances for the best effect and get all of those little hacks in place that help you save money, build wealth over time, and just layer in really good money habits. So this is one of those topics that I often do brush over, but I am responding to what people are talking about, and I want to let you know today about how loans work at a real fundamental level, how they accrue interest, why you pay what you pay, and then how amortisation works on a home loan over time. So that's what we're going to talk about. We've got a whiteboard session here. Let's dive right into it. Everyone is probably familiar with the fact that when you borrow money, you are paying interest. Now there's a whole world of how that interest is charged. Let's just say in general, interest is proportional to risk generally. And among the lowest risk, or considered the lowest risk loans in Australia, housing loans, particularly for an owner-occupied purpose. So we're getting loans at the lowest end of the risk spectrum. And at the moment with Reserve Bank at 3.6%. Those loans look like 5.25 to 5.5%. That's kind of what we're saying. So the bank is acquiring money from the Reserve Bank and from other sources, but the Reserve Bank is kind of setting the market at 3.6%. It's buying that money, and it's a wholesaler. It's buying it in bulk and distributing it to retail sources, you and me, in the version of home loans. And they've got to put a markup on that. Like any retailer, it would buy things from somewhere else in bulk, it would mark that up, and that would pay for its costs of distribution as well as its profit. And then that's what you pay when you get the retail price of your goods. So the retail price of your debt in a home loan setting is around 5.5%. And so there's something like a 2% markup that the banks put on top of what they're buying, the money that they're buying, in order to give it to you, and that covers their costs. Now obviously it covers well beyond their costs because they are insanely profitable, but that's about the difference. So there's the market there. So the Reserve Bank is setting interest rates and you're paying a markup on that wholesale money. But how does that all work? How is interest calculated? Why do you pay what you pay? So imagine you take out a loan, and I'm going to flip the chart here. So rather than, most people think of a loan as a negative, right? You're in negative money. It's a bit hard to draw that. So we're going to flip the idea here. And so the loan is going up, right? So this is dollars of debt that you have. Hopefully you can see that. Rightio. So you take out a loan, and we've got time across the bottom here, time in days, we're going to do. So you take out a loan, that's what you owe on day one. Now that debt will incur the interest, the 5.5% that I mentioned. And it'll be calculated on that day, right? Based on the closing balance of your bank account on that day, right? And the closing balance here is whatever that is, let's say $500,000 in debt. There are 30 days in a month roughly, or give or take, but each month is slightly different. But essentially we have a month here, and each one of these days will have a balance that is calculating the interest. Basically, each one of those days has an interest charge associated with it. So these all have a charge associated with it. And then at the end of the month, the bank adds up all of those charges and charges you. So that's when you get your interest cost at the end of the month here at day 30. So that's how it works, and that goes on and on and on. So what does it mean for you? If you're paying your principal component, which is the point in time, so let's go back to a more sort of regular looking chart here. Most people are going to be on monthly repayments as the default, and so they're going to carry exactly the same debt balance each and every day for 30 days. And then at that point in time, they're going to make a principal repayment, and that's going to bring their debt down somewhat to its new level for the next month. So the amount they pay at this point is the sum of all that interest on that debt, plus this little amount of principal repayment at the end of the month, combined into one payment. That is called amortisation, by the way. Most people just know it as their principal repayment. Key thing here, interest-only loans do not have that component. So you go into the next month and your debt can stay the same. You can obviously pay it down voluntarily, but there's no requirement to make that principal repayment. So that's how it works. Now, if you put this over time in years on a mortgage loan, keeping in mind that the interest component and the principal component combined is a fixed amount, so you pay the same amount every month if the interest rates don't vary. Obviously, variable interest rates may go up or down and that could change your repayment, but let's imagine a fixed rate environment here. If we look at time in years, and each one of these numbers represents a month, right? And then there's a little step down there, because at first, when the debt is high, the interest charge is quite large compared to the principal component of that fixed repayment. But as you step it down, you reduce the interest charge somewhat, and therefore out of that fixed repayment, the principal component starts to grow. But it's very subtle at first. You'll see almost, if you're paying the minimum repayment, you'll see almost no movement in your home loan in the first few years. It'll feel like you're going nowhere. It's because the interest component is so large and the principal component is so small, and it takes time to etch away that balance. But eventually what happens is you do start to do it. And this is a really bad drawing, I'll draw it better than that. And the principal component gets bigger and bigger, and the interest component gets smaller and smaller. And that's why the standard repayment profile of a loan, again, if you're meeting the minimum repayments only, looks like this. Maybe a little exaggerated, but it sort of curves off, right? It doesn't go down in a straight line. The debt you owe actually stays quite high for quite long. And this is a really important thing. The debt you owe stays quite high for quite long, always incurring interest. The real cost of owning a mortgage is in this period here, right? That's when the debt each and every day calculating on balances right up in this level. So if you're going to find a way to pay less on your mortgage over time, you need to find a way to bring this balance down, right? And there are some very easy ways to do that. You can pay more often, and that's a great starting point, because you like to run these ideas through to infinity, right? Pay more often. Okay, so take the monthly repayment and make it fortnightly, which means as you go into that month that I drew, there's half of the month, and then we step the balance down somewhat, just a little bit, and then we go to the end of the month. So as we get all of these add-ups of interest charges throughout the month, we have a smaller interest charge for the second half of the month here, right? So therefore the interest you pay at the end here is slightly smaller, slightly, very subtly, right? That's fortnightly. Let's keep it going. Why don't we pay weekly? Okay, well then we sort of like have 4 step downs in the loan balance throughout the month, right? And that has an even better effect than fortnightly. Take it even further. How about daily? This interest is calculated daily. Why don't we pay into the loan daily, just to bring that balance down each and every day of the loan? Okay, well, take that idea even further. Why not even have the debt in the first place, right? So like, draw it on day one, pay it back on day one. It's gone. You never pay interest. Well, that's kind of the idea behind offsets, right? Or redraw, anything which puts more money into that loan as fast as possible. Now that's going to be a topic for another day. We're going to leave it there for today. We're going to get onto offsets and redraws. If you found this useful, please share, like, and do all the other things that you do. You know, just tell people about it. Thank you very much, guys.